Axel, thanks so much for joining us.
Pleasure,
I want to first ask you about one of Francine's interview subjects. She just spoke with Christine Lagarde, incoming president of the ECB. What do you think about Lagarde's ability to get money out of these governments, like Germany, for example, that the market is saying at least needs to put forward some kind of fiscal stimulus?
Well, we've been on a very much driven by monetary policy only game in town kind of scenario, where the central banks have been stepping in time and again to save the economy from a hit. And at the moment, Europe is in a downturn. We're not yet in a recession, but it is subpar growth. And Germany is bordering on to the second double dip technical recession. So things aren't going well. This is not the environment where fiscal policy in Germany, if you sort of assume the second half is like the first, should be at a big surplus, like 3% surplus. Actually, it's where fiscal policy needs to react. So the call of central banks that I've heard time and again for fiscal policy and structural policies to take more of a responsible approach is absolutely still adequate. It's still warranted. But I don't see action on the horizon. The only thing that needs to be done now is really drive forward fiscal policy a bit more and structural policy. So in Germany, for example, there should be some long-term investment-oriented, infrastructure-oriented fiscal expenditure. The easy thing to do is a tax reform, and if you don't want to do an income tax reform, you should do a corporate tax reform. Europe still lacks the response to the Trump tax reform 2 years ago. Taxes in most European countries have stayed where they are, and Trump has basically eliminated the differential benefit that European tax regime has with lower rates for corporates. Now the US is very tax competitive, and we're seeing the impact on that. We're seeing the fiscal impact, we're seeing the impact on the economy, and Europe hasn't responded, and that's not good.
We saw Peter Altmaier yesterday say he wants to talk about corporate tax reform with Olaf Scholz as well, but immediately it was met with criticism that the companies would get tax reform and the people would not. Inequality, of course, has been a big issue. There's been so much talk about helicopter money of some sort, a fiscal monetary collaboration. What do you think about new tools for central banks?
Well, the new tools of central banks basically have been used because interest rates were at a lower bound. They basically tiptoed into negative territory, but there is a limit to how negative interest rates can go because ultimately it will drive out cash from the economy. And so central banks have added balance sheet policies to that in the past, which means they're flooding the market with liquidity. But that doesn't necessarily lead to investments because whilst liquidity is there, you need investable and bankable projects. And that's been the problem in Europe. And the government can play a facilitator role by basically having expansionary investment policies. Germany has such a big backlog on infrastructure. Look at the bridges and many motorways. Look at the railway system. Look at 5G technology. So there's many, many areas where you could do long-term, impactful investments that you could fund at the moment. And I think Germany needs to move into that space. Yes, tax reform is an obvious tool. And if you need to have both eyes on the consumer and on the corporate, you should basically have a combination of income tax reform and corporate tax reform. But the last thing we heard out of Germany, it's not going to happen anytime soon, but it should have happened because basically the US has changed the name of the game with corporate taxes being where they are now, very competitive, and corporates trying to show profits again in the US because it's better to show profits in the US for tax reasons than it is in some of the major European countries.
What do you think about Mario Draghi's negative rates experiment? You touched on it for a moment, saying that if it goes on too long, it's bad. But has it saved the day in Europe? Is it time to move on now?
I don't think it has saved the day. I think the side effects of negative interest rates are quite pronounced. You can see in the banking system, every year with negative interest rates, interest income of banks goes down. Basically, the major product in European markets is a 10-year fixed rate mortgage. Every year where clients refinance a reasonably priced mortgage against one that is close to zero, banks' net interest income declines. Interest rates start in negative territory in safe haven countries like Germany. They remain in negative territory for 10, 20 years out. It almost produces a safe haven curse where basically banks in safe countries like Germany are doing less well world than banks in more peripheral countries that are fiscally less responsible, like Italy, where the yield curve basically enters into positive territory and is positively sloped throughout. A different interest rate environment, so it has different impact on countries at the core, like Germany, and countries like Italy. And that's what central banks cannot take into account, but nevertheless they produce with their interest rate policies these side effects, and they need to watch that.
What kind of effect has it had on a bank like yours, on UBS, when you're trying to now pass on the costs, negative rates to depositors? Have you seen that drive, for example, outflows in your wealth management business?
Well, so far we're doing it sort of at higher levels of deposits. So we've done that at the level of 1 or 2 million deposits on the account. We haven't really hit retail investors with that. It's an ongoing debate throughout Switzerland in every bank, because we have the most negative interest rate environment of most of the European countries. Over time, the longer we stay in this environment, that interest rate environment will be passed on. So far, we've absorbed the by non-charging interest rate, we've absorbed it into our profits margins. That is not something that banks can do forever. So in a short term, you can accept profitability to be lower. Medium to long term, you need to price out the charges you get from central banks through negative rates that they charge on excess deposits that we have with the central bank. So sooner or later, banks will be forced in that direction to bring the numbers further down at which level they start charging banks. But it's an ongoing debate. There's no decisions taken. You've
brought in Iqbal Khan to run your wealth management business. He is now embroiled in a scandal, reportedly a fight with Tidjane TM that led to him being followed under the suspicion of poaching. Is it the right time? Do you still feel confident in that decision since the news is broken? Well, look, he's not yet with us, and so this is an issue between him and his former employer. It is something where we, like everyone, are watching what is happening, but we're not commenting. We're not a party here. But part of your job is managing, big, powerful people to run this big institution. It looks like there was a clash of egos at the top of Credit Suisse that turned out disastrously. Are you worried about putting Iqbal Khan and Sergio Armati together? No, I'm not. We have made our due diligence, believe me, as a bank, in being in close contact and making sure that there will be no regret moves. And we've been very clear. We've done our due diligence as late as today. And for us, it's not an issue we want to comment on. This is really not for us. This is between the parties on the other side. And we're observing what is happening, but we're not part of this discussion. What about generally the practice of following bankers who leave? Clearly, poaching clients and talent is something that happens on a regular basis, even though they sign contracts to the contrary. Is this something that UBS would do? Look, there is a practice in the market, and if it's good practice that follows after people have moved, there is freedom of movement between jobs, between financial institutions, is part of the competitive environment, but it needs to be orderly. It needs to happen within contractual arrangements. We've been very, very clear for us that this is what we focus on. Everything needs to be by the book, and that's my sole focus. If it's by the book, competition between banks leads to people moving from one place to the other. I think that's part of competition, and it's good to see. If things don't happen by the book, I'm not in favor of doing it. All right, let's talk about this family office event, because we've already spoken with Zara Ferrari this morning. She's told us that more than half of the high net worth investors here are worried about a recession next year. A lot of them are moving to cash. But I think more interesting is that a lot of them, especially the younger generation that's now taking over, is investing in long-term, sustainable ESG assets. Are you seeing that trend? It's a trend, and it's one of the most fastest growing investment categories we have at UBS. Grows at a rate of more than 70% over the last 1.5 years. So the inheritance of these global wealths are looking at the portfolio of their parents and the family and are engineering it towards their investment beliefs. And many of them look at impact investing, look at environmental friendliness, and therefore are restructuring the portfolio as soon as they inherit that. And that's
really kicked off a big demand for sustainable assets. There is not enough assets in the world to please that demand. So we as an investment bank, we as an asset manager, as a wealth manager, we need to generate assets rather than trade existing assets. And that's where the capabilities of UBS come in very handy. This is what we're driving. We need to make that transition to a less carbon producing economy, and UBS sees itself as a facilitator on that way, and our clients have huge demand for that. So it's part and parcel of what we do every day.
A lot of your clients would be hit by, and this is a big what if, but Bernie Sanders has proposed an 8% wealth tax on the multimillionaires and billionaires in the U.S. I was wondering, how mobile is this wealth? I mean, how possible or likely is that a tax that would cut their wealth in half within a decade to lead to money leaving the U.S.?
Many of family offices are globally invested anyway. Many of them have subsidiaries around the globe and very often show profits about portfolio investments at subsidiary level as well as at the group level. So I think global wealth management is what we are good at, and actually global family offices is the major counterparty of where we work. It's the millionaire and billionaire families of this world that we usually work with. And they're very globally diversified. They're no longer just invested in one country, and many of them are very mobile. You've seen major family offices move from the UK to Singapore, into Dubai, into Abu Dhabi, and global wealth is flexible. And that's where I think the ability to tax is much lower in this income and wealth category than it is for less mobile people. These are global citizens of the world. They run global family offices. They invest globally, and therefore they very often have their headquarters where there is a very interesting and good tax deal for them. You know, completely compliant with all regulations and with all tax obligations, but there's a very mobile client base, and so I wouldn't overestimate the ability to levy local taxes without them taking re-optimizing decisions afterwards. So yes, many of them, you know, if you're under a U.S. tax regime, of course, as an individual, you're under U.S. tax code globally, but if it's family offices, if it's really institutional investors, and that, there's a lot more flexibility here.
Got it. Axel, thanks so much for your time. Really appreciate it. Axel Weber, the chairman of UBS, here at their annual family office event in Zurich.